Accounting concept number 12, convention of full disclosure. The word disclosure means to reveal all information without hiding anything. So here the information relating to accounting have to be completely disclosed. So that is what you see here as disclosure of all material information. And it also adds to preparation of accounts in a very honest and fair manner. So it should not give rise to any misrepresentation or fraudulent affairs. And because the management, as we know, is distinct from that of the owners, according to the business entity concept, we have to actually see to that there is full, fair, and adequate disclosure, because the owners actually trust the management, and they have entrusted the entire business into their hands. And these management to see to that there is full, fair, and adequate disclosure when it comes to taking into consideration all the accounting matters. Correct assessment about the financial position and the performance of the business unit is also a must. That means balance sheet is the one which reveals the financial position. So all accounts that will actually be helpful in preparing the balance sheet should actually be done in the right manner, and this only actually helps in the finding out of the performance of the business unit, and this performance further helps the business to take various decisions. Next, coming to the convention of materiality. So what do you mean by the term materiality? So here, as we have seen in the previous concept about disclosure of all material facts, so here it talks about that every information relating to the accounting have to be completely provided. So materiality means giving all room for providing information without leaving out any. So financial statements actually rely upon these material items to be prepared, and hence we can see that these financial statements is the one which actually helps the users of the business to take decisions, be it owner, be it the management, be it the government, or any person for that matter will actually rely on these financial statements in order to take decisions from their actual perspective. So here we also see that when we consider materiality, only that information which is necessary and relevant have to be taken. So that means anything which is unimportant or insignificant and irrelevant. What do you mean by irrelevant? Not related to something. So that kind of items have to be actually left out. That need not be provided or disclosed. Exception to the full disclosure principle. So here we see that these irrelevant items will come under exception to the full disclosure principle. That means it need not be provided. So materiality, which is subjective in nature, depends on. So what do you mean by subjective means? So that which is actually necessary, that which is actually going to be considered, that which is going to be the important aspect for accounting. So that will be the meaning for materiality, and this will actually base upon the amount involved in the transaction. So this is the most important thing, because every accounting information is going to be recording of figures which are in mathematical representation. So if you take purchases, you say purchased goods for rupees 50,000. So everything is measured in terms of money and amount. So that is one important aspect in materiality. And the next one is concerning about the size of the business. So whether it is a larger firm or it is going to be a medium firm or a smaller firm. And then the nature of information. So what kind of information will actually have to be provided under materiality concept. And finally, what is required for the taking decisions. So decision making persons will be normally from the management. So what does this management actually requires in order to take decisions for the good of the or benefit of the business. So any item may be material to one person, could be immaterial to another person. What do you mean by that? What is important information for one person may not be such a information to another. For example, you can say the owners want to know the profit because it has to be distributed to them, whereas the government wants to know the profit, not okay about okay with distribution, but in order to ensure whether to continue the business or not, whether really this business is going to bring in some economic growth or some kind of benefit to the actual society. So from this point of view, it is useful for every person. For some it may not be useful. Finally, the last 14th concept will be convention of conservatism or prudence. Usually the word prudence means, okay, it is referred to as playing safe. So normally you would have heard people say advising one to be prudent. It is actually one of a moral value also. Being prudent means, okay, you should be able to judge about the things that you are coming across. Okay, so this will be applied to the business in the point of view that when we take two aspects like the revenues and the losses, or the income and the losses, actually how do you have to see the business means, you should always keep in mind, okay, what could be if the loss comes, or if such a plan is executed, or such, okay, like the performance are taking place, will it actually give rise to any losses. So keeping in mind, okay, any losses, if losses comes, how will their business be able to manage. So keeping that in mind, they will have to actually provide for, okay, all possible steps. So here there is a very good example. It talks about closing stock. Usually closing stock will be valued. So while taking the valuation, two prices are considered. One we call as a cost price, and then it is the market price. So among these two, which can be taken means whichever is less. We don't say market price only should be taken, cost price should be taken. Among these two, whichever is less is going to be taken. So this is very good assumption of prudence. So thus we can say any increase in the value is not accounted unless it is materialized. This is very important. What do you mean materialize? Only when it takes place, or only when it happens, only when the transaction is completed, or finally it has come to pass. Otherwise we cannot consider that value. So this is, okay, again in consideration with the realization concept. Okay, only when the incomes or, okay, anything is realized, we have to consider. And furthermore, it puts restriction, okay, that not to anticipate any unrealized gain. Okay, you may just okay, things may appear as though some gain is going to be actually taking place in the business, but that should not be actually considered unless and until it is realized, unless and until it has actually taken place. So thus we can say against all possible losses, provisions can be